Disclaimers. 1. The content shared in this podcast is strictly for informational purposes and should not be construed as financial or legal advice. 2. The opinions expressed by the hosts and guests are solely their own and do not represent the views of their employers or affiliated organizations. 3. None of the projects or companies discussed should be considered as endorsements or recommendations. 4. While efforts are made to ensure accuracy, the information provided may not always be up to date or entirely reliable. It is advisable to conduct independent research and seek professional guidance before making any financial or legal decisions. 5. The hosts and guests of this podcast shall not be held liable for any consequences or actions resulting from the use of the information provided. 6. All content, including text, graphics, and audio, is protected by copyright laws. Unauthorized reproduction or distribution is strictly prohibited. 7. Any discussions on sensitive topics aim to foster inclusivity and respectful dialogue, but differing opinions should be expected and not attributed to the podcast creators or sponsors. 8. By listening to this podcast, you acknowledge and agree to these disclaimers, and you are responsible for your own interpretation and application of the information presented.
Well, hey everyone, super excited to be here for episode number 2 of the Intersection4 podcast. We have your usual guests here. We have Hamis. Hamis is a founder of Plutus 21, which is an investment firm focused on crypto and other emerging technologies. We have Brendan, who is today representing Max Verstappen with the champions mentality with the red shirt. Brendan is the founder of Athena Intelligence, a company dedicated to casual AI. And you have me, last and least. I'm also an engineer and pretty active in the crypto community as well. But yeah, super excited to be here one more time. Talk a little bit more about some of the most recent things that are happening in the world of technology and business. We have 3 topics prepared for you guys today. So the first topic is the recent move of TradFi and traditional financial institutions into crypto. There's been a lot of news lately with applications for spot Bitcoin ETFs and new exchanges getting formed and a bunch of other things related to the shift in regulatory landscape of crypto. We also have an in-depth analysis of how the funds by FTX moved and the entire commingling of those funds that Rich is going to bring to the table. And we're going to have a more holistic discussion at the end of the intersection of future technologies as well. So, okay, super stoked to be here and super happy to be reunited with everybody again. And let's jump straight to it. All right, so the first topic that I'm bringing for discussion for the gang here is, we don't want this offer. The first topic that I'm bringing for discussion for the gang here is the general move of TradFi into crypto as of the last 2 weeks and how the timing is really interesting. So I have a few things that I want to go over here. So what we're looking at on the screen right now is just the news, right, of the recent application by BlackRock for a spot Bitcoin ETF. So there has been for a few years now already an existing Bitcoin futures trust by Grayscale called the GBTC. It was kind of like the first taste that we got an institutional access to crypto, and it was actually the GBTC trade, the arbitrage trade between GBTC and BTC was actually a pretty big fuel of the last bull run that we had. There was a lot of financial institutions leveraging this trade for the longest time. There's a lot of really good explainer videos on how this played a role in the bigger macroeconomic, or should I say bigger micro cycle of the last bull run. But this existed already. The big difference right now is that instead of having a futures, right, a derivatives trust financial product, BlackRock and Fidelity as well, and that's the other thing that I want to pull up here. BlackRock and Fidelity are both recently just filed for a Bitcoin futures ETF, a spot ETF. BlackRock, the application was, I think, 3 weeks ago, and then 2 weeks later, Fidelity also made the application. Interesting to highlight in BlackRock, Coinbase is going to be the custodian for the underlying crypto assets. BlackRock, as we all know, and in case the listener doesn't know, is the biggest asset manager in the world. They have like $10 trillion under management, and probably has a really high chance of getting this ETF approved. So the entire industry is super excited. Bitcoin rallied significantly after this application came through, because it's very likely that it's going to get approved, and it's probably the first taste that we're going to be getting at a true mainstream TradFi product that is tied to crypto liquidity and that's going to bring a lot of liquidity into the crypto markets. Beyond that, though, a lot of people are resurfacing this news that came out in March. There hasn't been much of an update ever since, But in March or so of this year, Nasdaq announced that they were going to be bringing a product for crypto custody. So Nasdaq ready to launch crypto custody by the end of the second quarter. No news have come out just yet, but this is people are just kind of resurfacing this and bringing this up as part of this bigger wave of TradFi adoption of crypto. And the last thing that I want to highlight too is
Sam, can you pause
this.
real quick and explain TradFi?
Yeah, that's okay. Okay, let's start there. So TradFi, the way that we usually name, so we refer to TradFi as the traditional financial institutions. Crypto people make a really big distinction between crypto native companies or Web3 companies and Web3 financial products versus traditional finance. So when we say traditional finance, we mean your large banks, your large brokers, your large hedge funds, your large exchanges. When we mean crypto or crypto finance or crypto native, we mean as close to on-chain financial activity as possible. And even a lot of people would consider like Gemini or Coinbase or Binance as crypto finance or crypto native companies as well. So that's a big distinction here. So when we say TradFi is adopting crypto, we mean all the traditional financial institutions are starting to move into the space. But just to wrap this up, the last thing that I want to share is let me just find this here 1 second. As of 2 weeks ago, there was a really big announcement, and this is actually really interesting as well, that Schwab, Fidelity, and Citadel Securities were coming together to launch, as the biggest investors, to launch an exchange called EDX. EDX is going to be a non-custodial exchange um, that already, I believe, already launched. I don't know if it's already operating, but this was already announced and is making headlines. So what they mean by a non-custodial exchange is actually an interesting situation in crypto. So when you want to trade in Coinbase, you deposit money to Coinbase accounts, or if you want to trade cryptocurrency on Coinbase, you need to deposit your cryptocurrency to wallets that are controlled by Coinbase, and then that money actually reflects in your Coinbase account. The difference here is that they are hiring third parties to do the custodial aspect of the exchange. So they're decoupling, as this happens usually in traditional markets. The brokerage is decoupled. The brokerage and the custody are decoupled from the actual exchange. So the exchange where things are executed are not the same is not the same place where all the assets are held. So if I want to trade on Nasdaq, I don't go and deposit my money in Nasdaq to be able to trade on Nasdaq. I have a broker with whom I deposit money, or they probably have a different company that provides custodian services, and then I trade on Nasdaq through that broker. They're following a similar model, which is something that hasn't been done yet in crypto for crypto exchanges. So a lot of traditional financial institutions, you can deposit money with them. They're going to act as a broker, and you're going to be trading on this venue through API calls. So it's kind of an interesting dynamic, a new model for an exchange, and it's backed by some of the biggest traditional financial institutions as well. To wrap this up, then, and I'm going to stop sharing my screen here, but to wrap this up, it's really interesting to see this because in the last month or so, we went on, or should I say, the SEC went on a rampage after every major crypto company. So they went after Binance, the DOJ may get involved in the Binance lawsuit as well. They also went after Coinbase. In the lawsuit that was presented against Binance, they labeled a lot of cryptocurrencies like Solana and others as securities. Like verbatim, they said they are listing unregulated securities and registered securities, and listed I think 14 of those 14 tokens. Amongst them were Solana and some others. So it's interesting that this new exchange at launch is trying to be hyper compliant. They're only trading four assets. They're trading Bitcoin, Ethereum, Litecoin question mark, and Bitcoin Cash also question mark. But it's interesting to see that there is a move of the traditional financial institutions into crypto with the spot ETFs, this new exchange, the custody solution by Nasdaq, and a bunch of other signals, right in the middle of what was arguably the highest level of regulatory uncertainty of crypto. So a lot of people in the industry are raising an eyebrow and being like, why do you go after all the crypto companies and just now all the traditional financial institutions are starting to move in? So a lot of people are trying to like think of conspiracy theories in their head to see how these two things relate to each other. So that's the presentation of the topic. I'm going to pause here and I just want to pass it on to you folks. I'm really curious to hear all your thoughts on this.
Yeah.
What's your guys'
Um,
read? Why do they do that? I'm not as close to this.
so like I'm not a conspiracy theorist. Like I listen to them because they're interesting. But I don't think I believe like even one of these like really well known and understood conspiracy theories. It's from a simple class in college, which taught me that usually the simplest explanation is the right explanation for basically everything. And it's really fun and interesting to talk about all the other possibilities and the ulterior motives, but usually the simplest explanation is the right one. So I've for a long time believed that this is simply going to be um, it's simply going to be an exercise of increasing compliance. So if you think about how financial institutions work, one of my first internships was at a financial institution. You will almost always find that the compliance and legal department is two, three, five times the size of the investment department, right? So financial institutions are actually built on not their investment scale or their financial analysis scale. Like they're usually built on top of their compliance, legal, management scale. And that's just the truth. That's the nature of this business. It's one of the most highly regulated industries within the US. It's one of the most highly regulated industries in the world. And that's how finance works in the US. And that's actually one of the reasons why you have asset managers in the US like BlackRock with $10 trillion of assets. And you have this like still to this day, for all the things that we get wrong, the most amount of trust in a financial system is still in the US. So I always believe that these uh, fights between the SEC and Coinbase, SEC and Gemini, like all of these will not result in definitive wins for anybody. I think what they will all result in is more forms, more filings, more compliance requirements. Like that's all that will end up happening from all of this. That crypto companies will get a form that they have to file, crypto exchanges will get a new registration they have to do, but nobody's going to definitively win because it's hard to win. And Rich is a much better person to talk about this, but it's really hard to win on the interpretation of a law, right? Because everybody's just like interpreting this law a few different ways, and nobody's actually wrong and nobody's actually right. Just like an opinion on what they think it should be. So like my feeling is that what will end up happening is whatever courts look at this problem, they'll say, okay, neither of you are right, so we're going to give them something and we're going to give you something and we're just going to move on. And when it comes to compliance and legal departments, nobody does it better than these traditional financial institutions. So I think that's all that's happening here is that the SEC is seeing an opportunity to go work with companies that they just know will handle the compliance as like the number one priority. And even the investment returns and everything is like second priority in a lot of these places. People put money in them not for the highest returns most of the time. They put money in them for the safest place to park their retirement funds, their children's college funds, and things like that, right? So I feel that that's why the SEC is leaning towards them. And I think it will actually help the crypto community um, to lean into not just giving in to every requirement that the SEC brings up, but as we go through this, court proceeding, you should have trust in that judicial system. And whatever comes out on the other side, like these companies need to be ready to comply with all of the reasonable regulations. And if it's something that is unreasonable, then they have to make the decision of whether they want to operate in this jurisdiction, right? But I don't think it's so incompatible with what's uh, out there, and I don't think it's so incompatible with the foundation of crypto as people believe. I think it's just a matter of hiring more compliance consultants and lawyers, dealing with it.
So
Yeah, I
is the
think
timing then a coincidence?
no, no. Okay, so that was my point. I don't think the timing is a coincidence, but I also don't think the timing is orchestrated. Meaning, I don't think that Gary Gensler was working behind the doors with all of the CEOs of these really large traditional financial companies and say, "Hey, I'm going to go after all this crypto native companies, so you guys can move in." But I don't think the timing is a consequence. Is a coincidence. I think traditional financial institutions are realizing that the space needs regulatory clarity more than ever, and they can bring the regulatory clarity a lot to what Hamis was saying. They're also realizing that if something major doesn't happen in crypto in the United States, the opportunity of crypto for a lot of these traditional financial institutions is going to go away. It's going to go abroad. It's going to move somewhere else. So I think they're capitalizing on the opportunity that is appearing here, and kind of like the lack of a clear guide and a clear leader when it comes to regulatory clarity in crypto in the United States. And I think that's where a lot of these traditional financial institutions are capitalizing. To your point, Rich, I don't just think it's ironic. I think it's like semi-tragic. I wouldn't necessarily say that traditional financial institutions will end up owning the crypto business. This could be the same thing, but I just want to draw the distinction that if this spot ETF gets approved and we see a huge inflow of liquidity into traditional financial institutions, I think they may end up owning the liquidity, but they may not end up owning the business per se. I think there's a very core group of very hardcore crypto native people that still believe in the technology as like this the severely disruptive thing that is not going to be compliant to traditional financial institutions, but the bulk of the liquidity, because the bulk of the liquidity in the world exists in traditional financial institutions, but the bulk of the liquidity is likely going to be living with traditional financial institutions if some of this stuff actually goes through.
Yeah, I think that um, having a derivative Bitcoin as a diversifier to your portfolio, as maybe a way to juice your returns, like all of that makes sense. But there's a lot of other reasons why Bitcoin was created and why these digital assets are in people's portfolios, right? So I've spoken to family offices, outside of the U.S. that not for diversification reasons, not for return reasons, but simply for the fear of their wealth being confiscated, are holding their assets in digital assets, right? If you put them into a derivative of Bitcoin at BlackRock, that does not solve their problem, right? So there's going to be like different groups here. There's going to be groups that think about their motivation is something that requires them to custody the asset themselves. Those are the same people that don't want a derivative of gold. Like they don't want a ETF that holds gold. They want gold themselves, right? Like people have physical gold like sitting in a bank vault, right? But those people will also have gold in their portfolio sitting in a, let's say, Fidelity account, right? The gold is the same asset, but it's held for two completely different reasons. So I think it's going to be similar here as well. There's going to be people that hold Bitcoin for the reasons that require it to be self-custodied, and they will forever self-custody it. And there will be people that hold it in their portfolio for other reasons where it can make sense for it to be custodied, with Coinbase held as a certificate at BlackRock, and actually held as a certificate as DTCC, and settled however they want. But it doesn't solve the problem for everybody. That ETF does not, and that self-custody piece also actually does not solve the problem for everybody. So it's going to just create like two distinct sort of use cases and markets. Yeah.
Just real quick comments to your point of does BTC have any value outside of this context of being this self-sovereign asset that nobody can take care of you, take from you? I think it's the same thing that if crypto is just held in an ETF and you get exposure to Bitcoin via an ETF, it's no different than having exposure to to an ETF of rice or any other commodity for that matter, right? It just becomes a speculation purpose. But I just want to highlight that the bulk of the liquidity in the capital markets of the world exists in that context. The bulk of the liquidity and the people who have the dry powder to actually get exposure to buy some of these assets and then drive economic activity in these markets is not in the group of doing self-custody, hardcore self-custody that is my assets and is independent. It's Vanguard, it's BlackRock, it's Fidelity, it's Schwab, and all of those people that actually drive the bulk of the liquidity of the capital markets in the world. But the thing that I leave with is, I think we agree on this segmentation, right? This is not for everybody. But I think the thing that we can like have the final discussion here for this topic is this good for the space or not? That's something that I still can't wrap my head around. Is this good for crypto? And when I say crypto, I don't mean the institutional side of crypto. I mean for the crypto native people that are actually trying to build and trying to align at least a little bit with the vision of cryptocurrencies of building a decentralized financial system. Is this good or bad?
Um, yeah, I think net it's a good thing. I think the use cases were always going to be split this way. Uh, the truth is that we were actually going to discuss some of the financial crisis in the U.S. One of the reasons that a product like this makes actually sense in the U.S. is because of the strength of the U.S. financial institutions. Like no matter what you say, like in the background, there's this sense that your capital is actually safe, right? And even our biggest uh, even our biggest enemies like use U.S. treasuries to store their assets, right? So there's this like inherent sense that in this crazy world, there is one market and one asset class that still is less crazy than everything else, right? So for those purposes, it makes sense. Like people are not actually expecting, even if there's a war in the US, a nuclear war in the US, they are still actually not expecting the DTCC to go out of business, right? Like they're still expecting that to be okay. It's not the same case all across the world, right? So I spent the last like month or so traveling all over the world, like meeting these companies, meeting these entrepreneurs, and it's like the complete opposite there, right? Like there, it doesn't need a nuclear war for their assets to be, locked up. They've had much smaller things happen, and their assets have been locked up before, right? So there, if you launched a Bitcoin ETF, like you'd get like very minimal take. But if you launch a Bitcoin ETF in a market like this, where there is obviously a possibility that BlackRock goes bankrupt, there's a possibility that DTCC goes bankrupt, there's a possibility the New York Stock Exchange does not open tomorrow. And like there's all those possibilities, but those are for a variety of reasons, like very small possibilities. All around the world, it's not like that. All around the world, those are real possibilities where, like my own family in Pakistan, like we've been through situations where, and in Pakistan, our assets have been held up for 10 years that were, hardcore assets that like we owned were actually some of them were bearer assets, right? Like some of them weren't even in these systems. They were actually bearer assets that we held in bank vaults, and they were still held up, not because of war, but simply because of mismanagement in the finances of the government, and they didn't have another way out. So they decided, okay, all of your wealth as a country is now ours till we figure this out, right? My dad still has PTSD from that experience, right? So I'm not saying my dad is a Bitcoin buyer, but uh, somebody like him can understand, right? Like somebody like him can see it as I need to have self custody. And the most important thing about it is that anything above $10,000 of gold, you couldn't possibly self custody it in a safe manner, right?
Actually, I have the
But that,
perfect counterpoint when you're finished.
yeah,
It's pretty funny.
go ahead, Brendan. I'd love to hear it. But assets that are digital like Bitcoin, right? Like you could actually see somebody putting their net worth in it of millions and millions of dollars and be able to carry it around in a flash drive, right? Like that is not possible with the commodities that we discussed, right? Like that was not possible for gold. That was not possible for really any other asset. And so that's a powerful use case. It will be used all around the world. But I think Sam is spot on that let's say that use case all around the world, gold is about a $10 trillion use case. That's just like the assets under management of one US institution, right? Like, so the US market is just like so much bigger than the rest of the world that if the US institutions are on board, you'll see a lot of capital flow in that wasn't going to flow in without this infrastructure. But you will still have trillions and trillions of dollars that is possible outside the US without any of this infrastructure in place.
Brendan, to your point.
Yeah.
Yeah. So there's actually a corporate example, and this is an outlier, but two
Mhm.
and a half years ago, Palantir had cash reserves that they were trying to place, and they bought $50 million of 100-ounce gold bars, stored them, and paid for the facility somewhere in the Northeast is what they had stated to actually like physically hold gold bars that which they had purchased. And actually, last month they sold that position. Uh, but it's just you almost never hear anyone doing that, let alone a U.S.
Mhm.
company, let alone a tech
Mhm.
company. and then physically having to like back that with security. So
Yeah.
classic
What was
Palantir
the
model.
cost of the security? Like what would you think the cost of the security? It must have been a few percentage points a year, don't you think?
It had, oh, absolutely. Yeah, I don't know what the numbers were, but
So it was 50
they,
million. I would imagine it would be at least $1 million, right? Like I think at least $1 million of security a year. So if you hold on to that asset for 10 years, well, 10-15% of that asset is gone in security. So I
yeah.
agree with you. Like obviously like governments hold like physical gold as well, right? But they can do it because they're a government. But for each individual person, the best that you can do at scale, at more than 10, 20, $100,000, the best you can do is a derivative of gold, right? Like you'll have this like receipt of gold sitting in the Bank of England vault, right? Or you'll have the ETF of gold sitting also at the Bank of England vault or something like that. So at scale for individual people, it actually wasn't possible to hold hard assets at scale and be able to carry it around in your pocket. And more important than that, actually, you can carry it around in your head. Those are called brain wallets. So as long as you can remember the code, you could carry $1 billion in your head, and that wasn't possible any other way.
I wanna just highlight the philosophical historical significance of what you just said, Hamis. I'm reading this book. I strongly recommend it to anybody who hasn't read it yet. It's called
Hmm.
Debt: The First 5,000 Years. It's a story of the is a book about the history of money. It's
Hmm.
amazing to note what you just said, that this is the first time in history that you can custody a significant amount of wealth without the need of having an extremely large force to be able to defend it.
Hmm.
In all of history, if you wanted to custody a significant amount of wealth, whether that was a family's wealth or a nation wealth, you needed force to be able to defend that wealth. And that force usually came in the form of the military of empires, of countries, of governments. And even in the context that we have today, if I deposit my money in the U.S. In the U.S. banking system, and I have a significant amount of wealth in that banking system, I am trusting that the banking system is going to work and is going to sustain itself. But in a deeper level, I'm still trusting the U.S. capacity of
Hmm.
to defend that banking system. So I'm still trusting the ability of the U.S. to use its military to defend the society that we have built. The
Hmm.
beauty of Bitcoin and the beauty of cryptocurrencies in general is that this is the first time in history that a single person, just by remembering the seed phrase in their head, they can basically custody a huge amount of wealth for them and for nations even, without the need to having an extremely large force. So this is the first time that we're decoupling the ability to custody from the need to display force, and that is like generally very revolutionary from like a historical perspective. But okay, any other points here, or can we move on to the next topic?
So actually, a few things on the first thing that you said. I'm actually very intimately familiar with the grayscale structure. So grayscale actually is a Spart structure. So they actually hold Spart Bitcoin in a Coinbase custody account. Actually, the reason that it's not a very efficient structure is because there's no redemption mechanism built into the grayscale structure. So that's why there's a large gap between the value of the assets and what it trades for in the market. Because if there was a redemption mechanism, the arbitrageurs would collapse that collapse that difference. So the first version of this was the SEC allowed, a spot trust to trade in the pink sheet, so trade in the OTC markets with no redemption mechanism. So once capital went in, it could never go out, and it could only be traded in secondary markets. The second version that they allowed was after the CME futures had been around for long enough time. They allowed trusts and ETFs to reference that futures price and actually hold futures contracts to be able to replicate the return of Bitcoin. The problem with the futures price is that there's sometimes very significant costs of trading out of those futures and rolling them every quarter. So they can actually be a significant drag on performance, and you're not moving up and down with Bitcoin on a one-to-one ratio. This third version that's coming out is going to be similar, actually more similar to the first version, where it's going to be a Spot um, trust, which is going to hold the assets of Coinbase, with the key difference that you will be able to redeem your shares for Bitcoin back into your account, or at least dollars back into your account. For that reason, that arbitrage should close from, it's about 30% right now on the Grayscale Bitcoin Trust, it should close to essentially zero, because even if there was a 10 bip arbitrage, somebody would make money off of it and close it. So I'm like super familiar with this structure. I've actually worked quite extensively around it, and it's a small difference, but it's a very large difference, which is making this ETF application so different and important.
Well, thank you for the explainer on the financial mechanics of the history of Bitcoin financial products. That's why we have a financial specialist on the pod, I guess.
So actually, a question for Brendan. So, do you think a um, do you think AI or machine learning could have been used to flag weird activity? Because what Rich was talking about is that this is a problem that isn't specific to crypto, is not specific to FTX. Like this happens everywhere. So as an investor, when this whole FTX thing happened, my thought was, okay, how do we fix this moving forward? Right? And it wasn't just happening in FTX. There were like these massive companies in India, massive companies all over the world that after, Sequoia and SoftBank and all these massive companies that invested in them, you found out that they were making up their numbers. There was some funny business happening, right? So this, I'm always thinking, okay, how can we use the latest technologies out there to permanently solve this problem, or at least start moving in that direction, where an investor obviously cannot sit and look at your 50 bank accounts. But what if there was an agent on behalf of the customers and the investors that are going through your banking records and flagging things, right? And saying, hey, there's something wrong here. This should come up in the audit committee next time there's a board meeting. Because I've worked with auditors, I've worked with audit committees for a long time. Under a certain level of materiality, they actually have very little that they can do to protect the stakeholders, right? Because they can't possibly go look at every $100, every $1,000, every $100,000 transaction. And for some companies, materiality is like $10 million or $100 million, and anything below that is like totally off the radar, essentially. So, of course, if you depend on humans to go look through thousands of banking records to find these things, they'll never find it. But do you think, Brendan, it's possible to have computers sort of come in and help with this type of oversight and control?
Yeah, yeah. For context, I've seen the inside of a SOC, so a Security Operations Center for like a Fortune 50, as well as like a government size institution. Uh, in both cases, you run into this problem of signal and noise. So you can have high signal, so you can get a ton of basically flagged alerts. And that's like one part of like maybe the AI component that you'd be able to lean into is like how do we better identify things that are potentially fraudulent. And then two is then how do you operationalize that? How do you actually take action? So I think that's like a completely separate like AI topic that you're maybe talking more about, like the workflow and the actual productivity gains that that you can have. The difficulty with this compared to other AI topics is it's an adversarial on the actual flagging section, not the productivity section. It's an adversarial product in which the minute you have an AI that can identify something, likely someone will very quickly have that to also be able to identify, and then they'll build a new system that's not identifiable, right? So you're always chasing the next set. This idea of like better productivity, though, I think is really interesting. Like in the same way that like people are outsourcing the human element of labeling, like what does it look like to outsource the human element of actually like remediation? So for like L1, L2 analysts, can that be something that maybe looks more like a human plus machine symbiosis?
Yeah, because like I'll give you as an example of a fund. So funds have what's called a fund administrator, which is like an accounting firm. They will look at every single transaction that you do. They'll ask for proof of that transaction. They'll ask for like direct API access for every transaction that you do. And then you have an auditor who will look at what the work of the fund administrator at the end of the year, once a year, right? And both of these are one of the auditor is required by law. The fund administrator is not really required by law, but it's required by just practice, and because the auditor requires the fund admin, and if you don't have that, the auditor doesn't want to work with you. So it's essentially required by law. Now, having run these funds and having seen like the complexity of the transactions, and we are still a far simpler structure than what FTX or any of these companies look like. uh, it is very simple to get something that is, under that materiality. It's very simple to miss that. Like it's very easy to miss that. Like I do those transactions, so I know that the auditors, like when they're looking through 1,000 transactions, like that's something that's very simple to miss.
Yeah.
But our fund administrators, they actually are in a much better position to find these things, and that's why they even exist, is because they're seeing your transactions on a daily basis and not once a year, right? So the public companies out there are looking at it once a quarter, maybe once a year, but the daily accountants that are inside the firm or the fund administrators, they're looking at it on a daily basis. Now, they can actually, to a great extent, like find these things the way that this lawyer found it in FTX, but there's not really a great way for them to then push that knowledge up without getting stomped down first, right? And so I think if there was a way to have technology help, first of all, those like daily people that are looking at the books on a daily basis, and then have technology have a way to raise the flag to the right people at the right time, a lot of these things could be solved. Because what really bothers me is that when stuff like this happens, it makes you want to not invest in companies at all, right? Like, and you obviously can't do that. You can't like stop capital formation. Like you have to back the right people, and but for every 100 great people, there's like one bad person that makes it hard for the other 100 to form capital, right? So there has to be like a very like permanent solution to this. It has to be something that because when you look at back at these transactions, even a human looking at these charts is like, that was really simple to identify that he was paying his dad, right? Like that's like not so complicated. It just needs the firepower, the computing power to be able to go through 1,000 transactions. But the fraud wasn't so complicated, right? Like it wasn't like he was going through 50 shell companies. Like it was like the money came in and never went to the exchange, it went to his dad's account or whatever, right? So I don't even think you need such a powerful computer. You just need a powerful way of escalating the problem
I don't
that surpasses the CEO and the people that have an incentive to stomp it down.
I don't really think this is a technological issue though. Like I think this is entirely a human trust issue. So I wanted to share this meme here. It's a little burly. It's like an old meme. I had to like really dig it out. Basically says POV, you shorted crypto engineering and now you have an extra $10 billion to buy up every person who's ever started a company in this space. So I wanna highlight here that FTX and Sam were not a normal phenomena. They were a creation of the 2020-2021 bull market, and they like crypto in a way brought this upon ourselves. We brought the entire crypto debacle on ourselves because we elevated this figure without having much information about the background of this person or kind of like any sort of insights into the actual activities of the company, and we elevated this company and this person into the status of God. What I'm wondering here is like how much of this is actually just like negligence in a way from all the people that were involved in the sphere of FTX, and how much of this is just like human greed in a way that they're just trying to chase the next star boy. And even a question to you, Brandon, is like how long until something like this appears again for an AI company, which is now like the hype and the focus of everyone's captivating everyone's attention and everyone's new cute girl at the dance party, right? So how much of this is like just the way that capital markets works and capital formation and just VC in general? And how long until we see something like this again in AI?
Here's a fun one for you. It's not. I'm not going to bash an AI. Can't do that to my people. Um, but if you take a look at Medicare, Medicaid, we spend close to $1 trillion, I think 900 billion annually. In roughly, I think the latest numbers are 10% of that gets classified as fraud, waste, and abuse.
Yeah.
Right. And there's one state actually that does most of it. I'm not gonna name states on the podcast, but we I spent some time kind of like working at this problem in a previous employer, and it was just ridiculous because you have what in many ways you feel like could never happen at like that scale, 10%. So like close to, I think it was $90 billion at the time,
Wow,
could just be
that's crazy.
gone, right? And this
Yeah.
is This is the government.
So did you find, Brendan, that that was a problem that could be solved?
There's a lot of things you could bite off of it, but
Okay.
there's so many players. It's such a
But
long.
even if you could bite off 10% of the 90 billion, that's a worthwhile company, right? Like if you could bite off $9 billion, like forget the whole thing. Like that would be a phenomenal business and a phenomenal add to society. So it doesn't have to be perfect, but like we can make a dent.
We're trying
I
to.
think the
They're called
part.
the VBCs, value-based care programs.
One of the things that I think about all the time is the biggest tragedy in all of this, in the whole FTX thing, is that it makes it seem like this has to be a separation of custody and exchange because we depended on the wrong technology. But actually, there has to be this separation because we just depended on people, right? And we depend on the wrong people, obviously, but we depended on people. Because at the same time, when all of this was happening, companies like Uniswap that had created the entire custody layer, the entire exchange layer completely on chain had no issues like that because there was no way for them to misappropriate the funds, right?
Mhm.
And so actually, in my opinion, and I think a lot of blockchain people have the nuance to understand the difference, is that it actually enforces the need for complete on-chain, trading and custody. Because I've worked extensively on marrying the equities, custody, and trading markets, like marrying them into a system. I've worked extensively with my engineering teams on that. I've done the same thing on the crypto side as well. It sounds a lot simpler than it is. It sounds a lot more efficient than it is. And it actually isn't the solution. The solution is not to have two traditional finance companies do crypto, one do custody and one do trading. The solution actually is to do something like Uniswap. That's the end state of the technology. The end state of the technology is not EDX markets. That is not the end state of the technology. That's simply what the financial institutions are used to. So they're getting that. But over the next 5 years, I think that technology and that structure is obsolete, right? Like it doesn't actually solve the core problem because you're still having to trust, no matter how good those institutions are, you're still having to trust those institutions, right? And at the peak of it, there was no reason to not trust FTX either. Like the same. And so now instead of you just trading, you have to be an expert underwriter for every company that you ever do business with. And you can't expect that from like regular people. You can't expect them to underwrite the custodian, underwrite the exchange. So what you actually need is you need a system where there is open source everything, and the individual can simply trust the code, the math, the transparency, and they don't have to ever trust people again. And I think that is the tragedy of all of this is we've actually been pushed away from that. We were actually moving towards that until FTX happened, and now people are back to, hey, let's actually just go with the TradFi guys. But I think over the next couple of years, it will become clear that there will actually be even issues with those institutions, and we'll have to refocus our efforts back into a fully decentralized model, because that's the end state of the technology.
I think you're hinting at a deeper meta philosophical question about the future of crypto here that I think is really interesting. But I would say let's leave it for the next pod. I'm just gonna hint at it. I'm gonna sort of call the wrap up here. But what I want to mention on what you just said is, I think crypto to actually work, we need to move everything on chain. We need to actually build a usable new financial system that is built on a decentralized foundation. But I've had this conversation with Rich several times, and actually last week, Rich and I attended an event for institutional crypto and fraud prevention. And one of the really interesting topics that I kept bringing up to a lot of the panelists and the people that were attending the event was that it is really challenging to build a new financial world that is based on a decentralized system, because that implies disrupting the current financial system, and the current financial system is basically the representation of society. Right now, the current financial system is the United States government. We're not trying to disrupt a company. We're not trying to disrupt a taxi company. We're not trying to disrupt Google. We're not trying to disrupt Facebook or MySpace or the newspaper or any other technology that existed previously. We're trying to disrupt one of the most successful institutions of human history, meaning governments. And that is unbelievably hard to do. And sometimes, and I've had this conversation with Rich personally several times, sometimes I just get extremely cynical about the future of crypto. And I just think it's impossible to reach that, but we keep fighting, right? But I think there's a deeper philosophical, historical discussion that is worth having at some other point. But I think we're bumping up on. Oh, we already went over an hour here,
Yeah.
so I'm going to call for some final remarks here from the three of you. That was my final remark. I want to hear from the three of you guys. Anything else that you guys want to bring up?
Sure, absolutely. I think that I'm more optimistic. I feel that there's periods like this with every technology where it seems like, what we set out to do was broken up because of greed or broken up because of bad actors or something like that. But if the technology truly is as impactful as we believe and it seems, then there's nothing that can stand in the way, including governments, right? Including regulators. They can't stand in the way. It actually, they start seeing it as the solution to their problems. Like, wouldn't it be amazing if every transaction that happens in an exchange is always publicly available to the regulators, right? And they have an AI agent that they've built that goes through every single one of those transactions and it picks up the problems and gives them a report to investigate at the beginning of the day, right? Like, that's the type of stuff that really changes this, instead of just putting throwing the ball around, throwing the grenade around to the next guy and hoping it doesn't blow up, right? Like, that's essentially what's happening. Hey, take it from the crypto companies, give it to Fidelity, and see what happens, right? Like, you're not solving the problem. You solve the problem when you embrace the technology and like go deeper in. I think these are intermediate steps like EDX, like Prometheus is another one that everybody should look into. It's like another one of these exchanges that nobody knows where it came from and has the SEC's stamp of approval apparently. But yeah, I think this is an intermediate step, but we should continue to push both the regulators, the users, the investors in the direction of, hey, you actually can permanently solve your problems, get a fundamentally better market structure if you go deeper into the technology. The tragedy of it is that our poster child for that like new world was Sam Bankman-Fried, right? Like, that's the tragedy of all of this. Like, he was the one who was pushing, oh, we're going to create a new market structure. So that's making people like afraid of the concept, even though all that we need to be afraid of is that messenger, and that messenger is gone now. But the actual concept, the actual structure is still alive and well, and we should definitely work towards it.
My take on most of
Brandon,
these
final
things
remarks.
is, yeah, they in most topics, not just related to blockchain cryptocurrency, but the right answer or like the outcome that we think makes the most sense usually finds its way. It's just a matter of time. So yeah, I'm bullish on this, but we kind of step back and let's take more time.
All right, folks. Well, thank you all for spending an hour with us and listening to our thoughts. Episode 3 coming to you soon, hopefully in a couple of weeks. And yeah, thank you, Hamis, Brendan. Always a pleasure, and we'll be chatting, fellas. Thank you.
Yeah, thank you.
Thanks.
All right.